Many of you guys enjoy when I do videos on how to value stocks, how to do certain things, mistakes that value investors make. And a lot of you guys enjoyed my video on how to value growth stocks, and you found it very helpful. I got comments like this is an eye-opening video. It was something really special. I got so much positive feedback, and I believe this video is gonna be the same thing. I'm gonna share a lot of secrets, a lot of things I've never shared before, never talked about it on YouTube. I'm gonna teach you a lot of things maybe you never heard before, a lot of very insightful stuff. And I really enjoy talking about that stuff. And they don't get a lot of views, but I do enjoy talking about them. And this is mainly revealing my investment strategy, how I do certain things, how I think about certain things. And this is the strategy that has allowed me to return 27% in 2022, 28% in 2023, and 54% last year in 2024. I share screenshots on X every single year pretty much, and I talk about them on YouTube. I have videos. You can find them on the internet and all that stuff. And this is something very special. I never talked about it, but I'm going to talk about it now. It's not going to get a lot of views as much as when I do analysis videos. So all I'm asking from you, if you do enjoy it, please press the like button and let me know what you think in the comments. Now, before I get into my strategy, I just want to talk about certain rules or certain things that I have for my portfolio to give some context on my strategy after I talk about this. And the first thing that I try to do is I try to be concentrated within 8 to 12 stocks. I don't personally believe in diversification. I don't hold any index funds. I don't hold any ETFs. I don't hold the S&P 500, no mutual funds, nothing. I concentrate within 8 to 12 stocks. And I know to most people that don't have enough time to research stocks and do all these things, I believe diversification makes perfect sense to spread out the risk and take less risk in general. But for me personally, I have a lot of time to research stocks. I research them and I understand them as much as the CEO does. And I just have a lot of conviction, and I try to put my money where I have the most amount of conviction in a single stock. Like I have 25% of my portfolio in one stock, and I sleep well at night, and I couldn't care less about what happens because I understand the company so much. So I don't really believe in diversification in general, and I try to stick to 8 to 12 stocks, not more than 12, maybe 15 maximum. But normally I try to stick to 8 to 12 stocks in general, and I mainly believe in industry diversification. For example, if I want to invest in semiconductors, I'm not going to own NVIDIA, AMD, ASML, Taiwan Semi, Samsung, and all these kind of stocks. I want the best one or two of each sector. Maybe it's, let's say, AMD and NVIDIA. And I look, for example, for the banking sector. I'm not going to own Bank of America, JP Morgan, Wells Fargo, Citigroup. I'm going to choose one of the banking sector, and I'm going to own one of them. And this is how I structure my portfolio in general. The second thing that I do, or the second rules that I have, is I don't trim a stock just because it went up. And I believe this is a big mistake that people make, is they don't let their winners run. They buy a stock and it goes up, let's say, very quickly. They trim it or they sell it just because it went up, or just because it's now a larger percentage of the portfolio. And this is something that I really don't do. And it's something that Peter Lynch said, which he said, selling your winners and holding your losers is like cutting the flowers and watering the weeds. I mean, it's really bad to not let your winners run. I mean, imagine selling Palantir at $12 because it went up too quickly while the business was growing. So for me, I pay attention more to the business. If the business is still growing, if the company is not extremely overvalued, I let my winners run. And I don't care if it's 10, 15, 20% of the portfolio. I just let them run, and I let the management do their job. And I like to ride it out and just let my winners run. And I cut my losers more than my winners, actually. And this is kind of how I do it. The third thing that I do is I don't hold and hope. And this is a saying that I have is, for example, let's say you buy a stock, the stock goes down 20%, the fundamentals are deteriorating. Most newer investors, for some reason, this is something I noticed, they can't really take a loss. So what they do is they hold and hope. So they hope someday the stock gets back to break even so they can sell it and then they can move on. They don't want to accept the loss. They only want to sell at break even. Now, the only problem is some stocks, they just never recover. Walgreens has never recovered. Sears has never recovered. There's a lot of stocks other than Amazon and the big stocks They go down and they never recover. So for me personally, I don't hold and hope. If the fundamentals have deteriorated, if I realized I made a mistake, I couldn't care less if it's 10, 20, 50, 70% loss. I take the loss, I learn from my mistake, and I move on to the next investment. It doesn't bother me. I don't look back at the stock to see how much it went up to make sure I made the right decision. I couldn't care less. I just sell the stock and I move on. I'm like, okay, I sold it now. I learned from this mistake. Now, what's next? And that's just how I do it. And I believe this is the best way to do it instead of holding and hoping or dollar cost averaging down to lower your cost basis so you could feel better about a terrible investment. So the whole thing doesn't make sense to me. And I don't know why most of the newer investors, they really cannot just take a loss. But we should not have an ego in investing. We all make mistakes. Buffett makes mistakes. Buffett takes losses. All these investors take losses. So why do we believe we're better than them? We're not better than them. So we're going to make mistakes. We're going to learn from them. And we're going to make more money, hopefully, than we lose. And investing isn't about not losing money. It's about making more than we lose. We're all going to lose money sometimes. We're going to be wrong as long as we learn and manage it properly. And this is how I think about it. The last one, which is a very important one, and I kind of want to talk about this, even though a lot of you guys may not agree with me. But this is what I would say is I do whatever it takes to generate returns. And again, I don't want anyone taking offense by this because I'm not trying to generalize. But from my experience through interacting in the comments in my own investment group on X, most of the newer investors, they're not really open-minded. Like they like to belong to a certain camp. For example, the value investing camp, they make fun of the Palantir investors. Instead of trying to learn from the Palantir investors, how did this guy fight Palantir at $7? How did this guy value Palantir when I skipped it because it was overvalued? Maybe there's something I can learn from that guy. Maybe there's something I can learn from this person. So instead of learning from each other, they make fun of each other because they don't agree with what they believe in. And this is the whole ego thing, which I really don't get in investing. Or for example, there's a lot of the technical analysts, a lot of traders, they share charts. Many long-term investors would look at those charts and they would say, oh, he's just trying to time the market. They don't even try to listen to the guy, see what he's trying to say. Maybe there's something you could learn. And this is, for example, for me personally, I couldn't care less about what it is. If it's charts, if it's long-term, short-term, growth stocks, value stocks, Chinese stocks, Australian stocks, cryptocurrencies, although I never bought crypto, gold, whatever it is. My goal in the market is to make money, is to generate returns. This is why I'm in the market. I am not in the market to belong to a certain camp, and I'm not in the market to follow narratives. And I talk with everyone and I learn from everyone, and then I can choose if I want to incorporate that in my strategy or not. For example, a long time ago, I learned some charts from one person, and in 2021, or mainly in early 2022, I noticed a chart that was breaking down. And normally most crashes tend to happen in the same fashion when there's like a certain pattern, a trend line, a channel. And once the stock breaks down from the channel, mainly the S&P 500 and the NASDAQ, there's something major that's happening. And it's the market telling you that maybe something bad is coming. And this is what I did in 2022. And I got into a lot of defensive name and value stocks. And that's how I made 27%. And the same thing has happened right now. And I told people in my own investment group, once we broke trend at 6,000, I told them now is the time to have at least 20% cash. And so far it has been amazing. But a lot of people told me, oh, you're trying to time the market, you're trying to do whatever. But for me, I'm open-minded enough and I can learn and recognize certain things because I don't really belong to a certain camp, but I listen to everyone and I learn from everyone and I do whatever it takes to make money, not to follow narratives in the market. Okay, and this is the most important one and it's very hard to do. Now, for my own portfolio, the way I look at it is, and this is mainly using some rough numbers, there's 3 categories I have in my portfolio, and I'm going to give you some examples and how I look at them and all that stuff. But I tend to have 65% of my portfolio into compounders. Compounders meaning stocks that I like for the very long term. Hopefully, they're not cyclical. They have some kind of a moat, some kind of a competitive advantage, and I put a lot of money into them and I don't touch them. I don't trim them. I don't sell them. I don't do anything crazy. I just let them compound and I hold them hopefully forever, but I tend to want to hold them for the very long term. And those are stocks that can deliver at least 15 to 20% a year. I hope I get to close to 20% a year, because my overall goal in the portfolio is to deliver 20 to 25% a year. So if I can find long-term compounders that can deliver at least 20% a year, then I buy them in my portfolio. One example I talked about publicly on YouTube was Uber. And to give you a very simple explanation, Uber does have a moat. It does have a competitive advantage. I talked about it many times. But the stock is trading around 18 times cash flow. 18 times cash flow, and it's growing cash flow 18%, 24%, 19%, 17%. I believe it will likely be 20% because I understand the business well enough and I understand the pricing power that they have. Now, if Uber is growing free cash flow 20% and is trading around 18 times cash flow, I'm paying less than 1 time price to free cash flow growth. And if the company does not get a multiple expansion, then the return of the stock will likely be very close to the free cash flow growth, which is 20% a year. So in this case, I have Uber as my compounders kind of category in the compounders category. And I believe it could return around 20% a year for at least the next 5 years. And this is what I try to look for and how I look for them. Just good companies in general, decent companies could return hopefully 18 to 20% a year. I don't touch them and I hold them for the very long term, like Uber, Amazon, and certain stocks of this sort. And that's how I mainly do it. Now, I have 15% of my portfolio in something I would call growth or speculative. Now, this is mainly growth companies that are turning profitable or not as profitable as they should be. They're rapidly growing. They're in the growth stage. They don't have a moat yet. They don't have a competitive advantage, but they're still early on in their business cycle. Because they're still early on and there's a lot of risk, I size them accordingly. So instead of me trying to, fight over, if this company has a moat or it has whatever, if it's growing rapidly and they have a founder CEO and great management, maybe like Hims and Hers Health, I keep it within the right position sizing, where if I'm right and the stock goes up 10, 20, 30, 40, 50 times, then I make a lot of money. But if I'm wrong, then I don't lose too much because I'm kind of spread out within only 15% of my portfolio. Like with Hims and Hers Health, which I talked about on YouTube, I started buying it in 2023 around $8 per share. I put in 1% of my portfolio. Then I looked like an idiot because the stock went to $5.55, I believe, or $5.40. Then I took it to 2% of the portfolio. Now, because I took in such low risk on the stock is now up 300% from my cost basis, and it's much more than 2% of the portfolio. But in this case, when I put in 2%, when the company was unprofitable, if I was going to be right on Hims, which I was, the stock went up 300%. But if I was wrong and the stock went down 50%, then I would have lost 1% of my portfolio. So this is how I look at it. I don't really look at it in terms of if I'm right on the fundamentals. I know I might be wrong because it's speculative. So I try to focus on position sizing. So if I'm right, I make a lot of money. But if I'm wrong, I don't lose too much. And that's how I kind of look at it. Okay, now the last one, which is the most important one, and this is the part that I told you you're not really gonna hear it in other videos on YouTube, and this is mainly the cash position. Now, I try to have around 20% cash, but I don't like to have it sitting in a broker account and collecting 5% in treasuries or whatever it is. That's too low for me. I'm trying to get 20 to 25% a year, and I have the time to do so. Now, what I try to do is, the first thing I try to do is I try to put it in a lot of value investments. Now, normally in the market, you have something called a rotation, sector rotation. There's only so much money in the market. When the market is excited about something, it gets less excited about something else. And it's mainly a relation of growth and value. So last year, growth was favored. People were going into Nvidia, Palantir, Tesla, all these kind of stocks. Now, while these stocks were going up, stocks like Pepsi, stocks like the consumer staples, which are going up this year, they were going down last year because people didn't want them. They were, so attracted by the shiny stocks. So the less shiny stocks, the defensive stocks, they get to such amazing value that they would kind of act as a hedge when the market eventually reverses. And this is an example from 1999. In the same day, the NASDAQ made a new all-time high. Berkshire Hathaway, Warren Buffett's company, made a new all-time low in the same exact day. The white line is Berkshire Hathaway. The pinkish line is the NASDAQ. In the same day, it made a new high. Berkshire Hathaway made a new low. And that was an amazing time to buy value. And when you bought values, the Nasdaq went down, and then Berkshire Hathaway kind of outperformed the Nasdaq, and it went on from there. And this is kind of how I did it in 2024. I had a stock called McDonald's. I had some cash. A lot of the shiny stocks were going up, but McDonald's was an amazing company that has gone down. Now I know McDonald's is not going to return me 20% a year, but it could return me 13 to 15% a year. It has bad sentiment. It's trading at a historical low valuation. So why don't I put in some cash into McDonald's? Because McDonald's is a safer stock, and it will likely inverse the market once the market goes down. But if the market doesn't go down, then I'm fine holding McDonald's for the long term because I like the company. So it's kind of shorting the market without trying to time the market. You know, it's like holding your favorite stock, which will likely inverse the market if it does go down. And this is exactly what happened. Once the Nasdaq started going down in August of 2024, McDonald's went up 15%. You could see it. The Nasdaq went down and McDonald's went up 15%. Now on this day, I did not get to 15%. I got around a 9.5% return on McDonald's. And I sold McDonald's and I bought the dip on a lot of the growth stocks that people all of a sudden they didn't want anymore. A lot of them were AI stocks, amazing companies, down 30, 40, 50%. I sold McDonald's, I made 9.5%. It helped offset a lot of the loss in my portfolio, but it also gave me some cash to buy the dip on the hated stocks, which were back then the AI stocks, after all of a sudden people loved them. And this is what I do. I buy things that people hate and I sell them when I love them. This is what I try to do within my cash position. And I did the same thing this year. Last year, there was a lot of euphoria. I got into a lot of value names. One stock I publicly shared on YouTube and on X was Cheniere Energy. And I said, this is my top pick for 2025. So far, Cheniere Energy is up 7.5%. The Nasdaq is down 8.3% year to date. And this is another one that's helping offset the loss that I have on my compounders, on the growth stocks, and have many others that are up 20, 25% year to date this year because they were hated last year. As the value stocks went down, the growth stocks go up. I try to go into the value stocks. And then once the opposite happens, I eventually want to sell the value stocks once they get richly valued and buy into the growth stocks that people no longer want. And this is how I rotate between growth and value within my cash position. And this is mainly the secret of how I got 27% in 2022 and how I'm holding up much better this year in 2025, despite being up 54% last year. And sometimes I also sell options, put options and other things, not all the time, but some of the time. And this is how I do it for my strategy. I hope it wasn't confusing. I hope you found some value. If you want to join me on what I do and how I do certain things and participate in the amazing returns we have gotten, and I believe we're only getting started, you could check out the link over here and join my Discord, and I teach you how to do certain things. I have videos on how to value stocks and how to avoid value traps and everything I know, all within one platform. So if you do enjoy it, again, let me know in the comments, press the like button. Thank you very much for watching, and I'll talk to you in another video.